It's expiry day, so perhaps inevitable, but let's decode then the road ahead with Supreeth Shankarghal. He's the CEO, Olive Ridley Capital, joining in on the show. Supreeth, good to have you on board. Just wanted to understand from you how you're looking at the market mood. Of course, perhaps it's going to turn out to be one of the worst series that we've seen at the moment for the month of March. But what's your outlook on the road ahead? Do you sense that, by and large, we will see corrections along the way, but that the momentum in the market is here to stay on the upside?
Hi, thanks for having me on the show. Yes, March has been a particularly tough month for global markets. It's not just India. We saw tech stocks correcting deeply in the month of March, and now that seems to have subsided. But right now, I think what the markets are worrying is about the rising 10-year US Treasury yields. It's cooled down in the late day or two, but it is expected to go up. I think, in my opinion, it might even go up to 2%, and that will bring it will bring a lot of weakness for the market at least in the short term. And 2020 has been a great year for the markets. We saw markets recovering close to about 70% from its 52-week lows. So as with otherwise any big move in the markets, we should be expecting some corrections along the way. And right now, the valuation seems to be on the higher side, especially with India, the PE ratio being at the present moment being 35. It's higher than some of the global peers like S&P 500 and other European indexes. So although the global long-term outlook for the markets is not too bad, I mean, in my opinion, we're still nowhere near a correction kind of a territory. I think we will continue to do well, but 2021 particularly will be a year where you focus more on stocks rather than the index. The index may not end up having a great year like 2020, but we may do something like 5 to 10% move from the present levels. But that will be coinciding with a lot of healthy corrections along the way.
And how do you sense the overall liquidity situation, Supreeth, is likely to shape up? So far, it has been quite favorable for the Indian equity markets, but do you sense that with the dollar, gaining strength, that may tamper with the equity flows?
Yeah, I mean, particularly rupee has been one of the best emerging market currencies at the moment. But as the US Treasury yields continue to rise, some of the foreign investors may become hesitant and may start taking profits in some of the growth stocks that have done really well over the last 1 year or so. And that might see some outflows and even deleveraging in some sectors and moving into safe, liquid investments. And that may bring some near-term weakness for the markets, but I don't think it should be cause too much of a worry. So we will continue to. India particularly stands among the best markets to invest in terms of emerging markets, because India and Australia have done really well to manage the coronavirus crisis, and India is poised to be the leading market for V-shaped recovery in GDP, and especially GDP is expected to be going to be very well. Is expected to do very well in the next year. So India will be one of the key markets for foreign investors to invest, and I think India should do particularly well at any correction, and that will be a buy on dips for most investors, in my opinion.
Okay, so you continue to remain quite bullish. It's a buy on dips market. Where is it then that you would be allocating money in a market such as this, in terms of which sector is it that catches your fancy? Would it be the cyclicals as well as going forward some of the financials and high beta pockets? Or do you think the defensive tilt is now making a comeback?
Again, it's a global trend that the travel industry is expected to do well as more economies open up. Air companies like airlines and hospitality industry is expected to do well, and I would suppose the same theme holds good for India as well. And we like hospitality industry, some stocks like, say, Indian Hotel and some of the airline stocks. And also there has been a global construction property boom across the world because property prices were were expected to drop during the COVID crisis, but it didn't. And surprisingly, it has been going up in quite a lot of developed economies. And I think once we kind of fully recover from the current COVID crisis and the lockdown that we are facing in so many countries across the world, I think there will be a big construction boom. So that should mean metals, steel and iron ore doing really well. Travel and stocks and hospitality stocks should do really well. And also technology, especially the outsourcing names, Infosys and TCS will be probably doing really well in the next coming quarters. So we will be really bullish on technology stocks, hotels, and steel and iron ore in India.
Stay on with us. Lots more to talk about. Let's slip into a quick break then, right here on the show. Be right back.